Hi everyone, welcome to the first video of Beyond the Beta, and today I would like to start the video through a very interesting topic that I have been working on and discussing with a fund manager I know, and it's called the bear ratio. So when I started working on it, I realized that it has done quite well in the past and also has generated a buy signal on the Nifty 50, which is quite interesting. So if you don't know what the bear ratio is, that's totally fine, because my plan is to cover it in a very simple way so that you understand what it does and how you can use it to invest your money wisely. Okay, so let me explain how the bear ratio works. So firstly, the bear ratio implies two things. One is the bond yield and one is the earnings yield. So the formula is bond yield upon earnings yield into 100. So obviously the bond yields that we use are the 10-year GSEC securities. So currently for India it's at 6.8%, and earnings yield is basically 1 by P into 100. So if the Nifty is trading at 20.7, you would get the earnings yield as 4.8%. And when you combine these two things in the ratio, you get a certain number. Now the thing is that most of the people who have studied this ratio, they just leave it out there because the number that comes out of the bear ratio itself is not enough to generate a signal, right? So what we use is something called the Z-score, which is basically saying that in the past 200 trading days of the Nifty 50 and the GSEC, how unusual the bear ratio has performed. That's how you understand the Z-score, and don't worry if you don't understand what I'm talking about. You can just put down your emails in the comment and I will send you the code file and the explanation of how it works and what's a Z-score. Okay, so once you get that Z-score, you basically understand how the market is performing. Now someone would ask that if the bond yield is already at 6.8%, which is risk-free, of course, because it's from the government, why would you invest in the stock market, right? So the idea behind the bear ratio is that after one point, the equities will get cheaper. So it's more beneficial for you to buy the equities rather than the bonds, because there's a high chance that you will generate more than 6.8% of the returns. So let's take an example. Suppose you have the bond yield at 6.8%, and you have the earnings yield at 4.8%. I'm taking this example from the 31st of July, and once you calculate the Z-score, you get a Z-score of minus 0.93. So the idea behind this strategy is that you have to keep three things in mind. Number one, that the Z-score, if you're buying the Nifty, the Z-score is in the range of minus 0.5 to minus 2.5, and the idea of selling is that it's ideally between positive 1 to 2.5. Now if you use this alone, you will not get a good entry or exit because you don't have any clarity, since if the market is already falling down, you will not know where to buy, which is why I add moving averages on the technical side of things so you understand it better. So let's try to take a very simple example now. I will take a live one from one of the recent dates so you get more clarity on this. As on 31st July, the bond yield was around 6.8%, and based on Nifty's P, the earnings yield came to around 4.8%. Now if you compute the bear Z-score, you get around negative 0.93. Now I would like to explain you the basic rules behind using this strategy. And number one is understanding the range of the bear Z-score. So if you're in the buy zone, you have to stay between negative 0.5 to negative 2.5 as the buying range. And when you are trying to sell the Nifty, which is basically selling the Nifty Bees ETF, you try to sell it when the Z-score reaches between 1 to positive 2.5. Now, since this is not enough, the fund manager suggested another approach, which is basically using the technical indicators called moving averages. So the 50 and the 100-day moving average. How you use it is that when you're trying to buy the Nifty Bs, you have to make sure that on the Nifty chart, the 50 DMA crosses the 100 DMA, so you get a better position. Now the reason you do that is that you don't want to catch a falling knife when the Z-score is falling, because they will give you a cheap buy signal, whereas the Nifty is falling to a certain psychological testing zone, which you might not know about, right? And this is why the DMAs help you to get a better entry and exit in the markets. Since equity analysts also take time to review their downgrade earnings, you might not get the signal. Similarly, when you're trying to sell the Nifty, once the Z-score reaches between 1 and positive 1.5, you wait for Nifty to crack down the 100 DMA and then you exit, because there might be a chance that it's shouting sell, but the market keeps going up as it does in a bull run, right? So you might miss on that opportunity. I'll try to give you a personal example that I use. I started buying the Nifty B's ETF in June because my Z score was giving me a very fair valuation, but I did not wait for the DMA because obviously this was a big correction in the markets and I wanted to enter first. So since then I have made around 3.5% in the markets already. And the benefit of using is that if you had been tracking the Z score, you would have probably escaped the crash between January and March, and then there was another buy signal in March and exit in June and then a re-entry. So the benefit of using the Z score is that you can try to time and exit at a better time in the markets. Now, one thing I would say that the strategy is not doing well is the return compared to a buy and hold. So if you buy the Nifty and hold it for a long period of time, you're getting lesser returns if you are doing the buy and sell strategy through the Z score. So I backtested this for the past 9 years, and the Nifty buy and hold strategy gave a return of around 13-14% with a volatility of 38%. But if you are a more risk averse investor and want lower drawdowns, obviously you can go for the beer Z score because it will give you 9.5% of the returns, but at half the drawdowns, which is around 17%. So you're still making more than the bond yield and you have a lower risk in the markets. So you should try the strategy out. I will obviously share the Python and the explanation once you drop down your email, and if you're interested in knowing about it, I will send it through the mail. And do let me know if the strategy is working for you, because right now it is still generating a buy signal, and if you see the Nifty charts, it's closing the 50 and 100 DMA gap, so it is a very solid entry point and the market has already shown strength. So I think it is time for a bull run, but obviously this is not an investment recommendation. This is something interesting that is working in the markets, so you can do your own backtest, study more on this and try to create a conviction and enter the markets. So do let me know if you have any questions, and thank you so much for watching. Stay tuned for Beyond the Beta.